Your Excellencies, distinguished guests, good morning. It is a real privilege to moderate the first panel here at the very first Global South Utilities Forum. A real privilege for us to be able to engage with this audience on a really important topic, which is unlocking capital for the Global South. My name is Bart White. I run energy structured finance for Banco Santander. Energy structured finance is our business that finances renewable energy, but everything in and around the energy sector, so other tangential technologies like batteries, hydrogen, carbon capture, energy from waste, the list goes on and on. But renewables is a key part of our business and something very close to my heart. Last year, 2025, we arranged circa $15 billion of renewables financing, so globally the #1 renewables financing house. And that activity, the reason why we're #1 is not because of our activity in the Global North, but because of our activity globally, including the Global South. So the #1 renewables financier in Latin America, for an example. So we're very, very pleased to be able to be invited and for me to be able to moderate this incredible panel. I've been reflecting on the topic, unlocking capital, a phrase which is perhaps used quite frequently as a shield as opposed to an enabler. Where people say, we need to unlock capital, it suggests that there's a problem, it's not me, it's you, it's not me, it's something else out there which is stopping me from lending money. We really need more ambition, we need more ability to explore, to do deals in places we haven't done deals before. I think that's going to be essential in making sure that we bring energy as well as water, as well as food, as well as healthcare, as well as many other things which are required to help enable growth in the Global South. We need energy. Energy is an essential for people. It's an essential for communication. It's essential for data. It's essential for progress. So again, a really important topic. Very esteemed panel. I'm going to let them introduce themselves. Why don't we start with Amir and go along the line.
Thank you very much. Very nice to meet all of you. My name is Amir Beg. I represent the Green Climate Fund, where I run the co-investments and strategic investment partnerships part of the business. The Green Climate Fund, very briefly, is the world's largest climate multilateral fund. We've committed around $20 billion, with which co-financing it takes it to just under $80 billion. We operate across the global emerging markets, across the climate sectors very broadly, so energy access, renewable transition, through to food security, healthcare, financial services, and deploying our capital across the whole capital stack, from grants through to early stage equity, commercial equity, highly concessional debt, and then commercially priced debt as well. So looking forward to the discussion.
Yes, my name is Salah Al Nasser. I'm the CEO of Equiline Finance. It's a part of resources investment group. It's also a sister company for GSU. So we already involved in a lot of energy project globally, or at least which is we are more focusing in the region. And we deliver different kind of power projects in solar, in wind, in hydro, and also a new version of alternative energies, all kind of bios. Thank you.
Hi, everyone. My name is Lina Osman. I run the sustainable finance team for Africa and the Middle East and Pakistan at Standard Chartered Bank. Very briefly, at Standard Chartered, we are a bank focused on, by legacy, on the emerging markets, although it's probably unfair to call some of these markets emerging anymore, including Africa, Middle East, and Asia. And within the sustainability space, we have sustainability as a core component of our strategy. We have made commitments to get to net zero from our operations and from our financed emissions by 2050. And we've made a lot of commitments around deployment of capital, $300 billion by 2030, and we're well on that track. If probably won't beat it. But lots of interesting solutions and innovative structures that we've been looking at in order to unlock that capital, and that's why I'm here today. Thank you.
Good morning, everyone. My name is Yuan Jiangsun. I'm representing the Asian Infrastructure Investment Bank, which is a multilateral development bank. Our bank is based in Beijing. We established 10 years ago, so we are currently celebrating our 10th anniversary. But I'm based in Abu Dhabi. This is our first overseas offices. Our mandate is to try to combine the global expertise of the bank with the local knowledge so that we can get closer to our clients and serve much better for our clients. Thank you.
Fantastic. What an incredible panel. First question, we have to focus on what the problem is before we discuss the solution. So the conversation is around unlocking capital, so we need to find out what the lock is. I mentioned it's important to be willing to explore and do deals in new places, but Amir, what are the barriers that we can identify that need to be overcome to unlock capital for the Global South?
No, thank you. Look, I think they fall at least principally into three main categories. There is, of course, the classic traditional one, which has been forever, as long as I've worked in finance as well, which is perceived versus real risk. And that then stymies the flow of capital coming into the emerging markets. And what we try to do at the Green Climate Fund is provide different types of capital at different stages of the transaction to reduce or at some points eliminate some of the initial risks that exist in there in the transactions to give the investors comfort that they can make the returns that they need and to help to build up that muscle memory so they see that on a repeating basis and building up the capacity to address those risks. We also work very closely with governments and different ministries within governments by providing what we call readiness capital. This is a facility which we have which is north of $500 million, which is fast dispersing grant capital that goes to governments to help build capacity and put in place different policies and procedures, which helps reduce other types of risks related to rule of law and capacity issues and enforceability issues on contracts. So I think those are some of the elements which we've been working on to reduce that gap in the risk. Of course, in that, I'd be remiss not to include FX risk as well. And we very often provide concessional financing to remove and eliminate parts of the FX risk in transactions, whether it's related to hedging costs where they're appropriate, or indeed even available at something which is reasonable, or removing some of the FX volatility within transactions. Another component is the quality of entry. It's the pipeline. It's the bankability of the pipeline. I think the need and the necessity to make sure that projects which are not bankable but should be bankable are identified and worked on with great focus. And we have project preparation facilities which provide grant capital again to help take those projects to bankability. But I think it also requires a very great level of discipline to ensure that the projects which are being worked on and taken to that stage are indeed good projects, and they're just not weaker projects being made slightly less weak in order to get other financing in and then just kicking the can down the road on the other problems. So I think that bankability and the way project preparation facility capital is used for that is also critical. And then finally, I would say, where applicable, it's also that, the monetization and the exit mechanisms that are available for investors. And I think ensuring that across the life cycle of projects, that these different risks are addressed and that liquidity is provided in order to develop the exit mechanisms helps build up confidence and increasing capital flows to come in at the beginning again of these transaction flows to then build up over time stronger flows of liquidity and reducing and hopefully over time removing these risks perceptions. And then one final point, I know I made another final point, but is the use of data. I think it's really important to continue to disclose as much data as possible, particularly from the institutions that are working in emerging markets, because when you look at data over an extended period of time, again and again, you will see that the risks of emerging market risk versus developed market risks are very minimal based on the data. And I think that's really important to keep re-emphasizing that. And that, combined with the cushioning of the capital that our type of institution can provide, helps reduce and remove some of those barriers.
Thank you. And building on that, we have a number of blended financing, guarantee structures available in the market. So Yangjiang, if you think about those barriers, which of those from your perspective are structural versus what can we solve?
Well, from the MDB perspective, the fact that the blended finance and guarantee tools exist but are not yet mobilizing capitals at scale tells us something important. The challenge is less about instruments, but more about how risks, institutions, and incentives are aligned. So it's very useful that we distinguish this structural constraint, which requires long-term reform, with the near-term barriers where we can move much faster if we can have a better coordination and design. So we believe that there could be three major structural constraints. One certainly is the country risk. This is the core concern by investors, which includes political risk, regulatory risk, currency risk, and contract enforceabilities. Certainly by using the guarantees, we can mitigate some of the risk, but they cannot fully substitute the strong institutions and the policy credibility. The second structural constraint is more about the local capital market. So in many global South countries, the local currency financing creates unavoidable foreign exchange risks. So this is a structural issue, requires time. It needs more capital market development, regulatory reform, and also institutional investors' participation. The third restraint, I would say, is more concerned about us as MDBs. The MDB balance sheet rules, our risk limits, the approval processes, which are essential for prudency, but can also limit the speed and flexibilities. So this is also structural, but MDBs, including us, AIIB, we are working very actively to improve that within our mandate. In addition to this, I think that there are certain near-term barriers which is more solvable. One of the most immediate solvable barriers, which I believe it would be regarding the project preparation and pipeline qualities. Many projects fail not because the finance is not available, but because they are not investment ready. So if we can have some target concessional or philanthropic capitals be deployed earlier in the upstream stage, so we can dramatically improve the bankability. The second barrier is more about the excessive bespoke structure. Too many deals are reinvested from scratch. So the MDBs can help by designing the key risk allocation elements, so that we can also allowing some local adaptation. The third barrier is more about the timing and sequencing of the instruments. Guarantees and blended financing often come too late. So if we can deploy this earlier, alongside with the policy dialogue, project preparation, this can certainly change the investor's perception before the risks are priced in. Last but not least is the coordination among the capital providers. The public, private, and the philanthropic capitals, they often work in silos. So if we can have a better alignment, so who takes which risk at what stage, and that could be achieved without waiting for the long-term structural reform. Thank you.
Fantastic. I think you touched on two really interesting points around the blended finance and what we need to do to effectively evolve that, and I'm going to be going to Lena in a moment to talk about that, but also earlier stage capital, which I'll ask Sela to comment on in a moment as well. I think both of those are key in building the soup, the recipe that will bring the capital in 2026, which is needed. So, Lena, just firstly on the blended finance, it has a reputation of sometimes being quite complex to execute, perhaps quite painful, takes a long time, but you are leading a number of transactions where you've cracked the code. So can you give some examples of transactions which have been able to crowd in private capital and have made blended finance a success?
So first of all, I would say all of the above is true, complex, painful sometimes. But I think, looking at transactions, I mean, even as a bank, we want to make sure that these transactions are scalable. We can replicate them. We don't want to spend, a year, sometimes even well over a year, working on transactions that are just kind of one-offs that we're doing. So, looking at scalability and how we can replicate is a key component of any transaction we look at. At Standard Chartered, we have the privilege of existing in, I call it some of the world's most interesting markets, because you have that ability to kind of be innovative, and you can bring in new elements of structuring to transactions. But what that has come with in terms of us being able to do these things is that we've been doing blended finance well before it was called blended finance. Taking different forms of how these structures were put in place, be it, starting off with like the simplest equation of a guarantee, and going all the way to the kind of more complex structures or more customized structures to kind of cater for the ever-evolving changes in our industry, in our markets, new ideas that are coming up. I think what really has kind of helped us crack the code is the deep knowledge of these markets, being on the ground in a lot of them, being able to also have that connectivity into the MDBs and the DFIs, even the governments, even the governments, and understanding, what basically they need to see. So, working with the GCF, for example, or AIIB, or the World Bank, etc. Each one of them has their own kind of requirements and their own ways of doing things. But some of the interesting things that we've done is, you kind of need to look at the basic point, which is the distribution of risk. And what are these risks that as a bank we are unable to take on, and then how can we distribute it? But also going beyond just working with the MDBs and the DFIs and just looking at a wider picture. I really like what you said about philanthropic capital, because that is sometimes something that is missed when we are looking at structuring transactions, especially on the social side. And in a lot of countries on the African continent, for example, I feel like there is a huge opportunity for us to do something there. But just conscious of time, some of the structures that we've actually been able to do include outcome bonds, and outcome bonds can be replicated across different sectors. So we've recently done a clean cooking outcome bond that can be replicated into another industry. Debt for nature swaps, everybody's been talking about them, but you could do a debt for anything swap, a debt for food swap, a debt for social swap, a debt for gender swap, for example. So all of that is something where the basics of a structure are there, and you're just kind of catering it to the right to the right solution that you want to put in place. So they're basically like different products, different facilities that can be brought into a structure. Country platforms is something that we've been playing around with and has been quite successful with us, where we have been working together with governments on identifying what kind of structures they need to put in place, be it through a fund, for example, that then invites capital into it and then invites developers to develop renewable energy solutions, for example. We've also been working together with private equity firms, whereby we would bring them in as a risk mitigant to certain transactions that we would get involved in, and that helps again with the whole point of the risk distribution. So quite a lot of these things going on. I would love to spend time to talk to you through each one of them and how it works, but I'm available later on as well after the panel to speak through them if this is of interest. But I'll take a pause there, just conscious of time. Bart.
Yeah, so philanthropic capital is incredible and something which certainly has a role to play. But we also need to look at banks, at DFIs, other forms of capital, especially earlier in the life cycle of projects. I think that's going to be essential in unlocking a boom of capital. It's actually the projects at an earlier stage which really need capital to reach FID. So, Sela, any comments on how banks, DFIs can reposition themselves to play in that really important space, so that earlier stage in the project life cycle?
Actually, if you look today, I was hearing some things said 1.4 billion, they don't have power worldwide. And I think 1 billion in Africa. If you look at this number and you think deeply why this number why this number big comparing other countries, you see there is a very big difference between demand and availabilities always. The problem always, most of, let's say, 90% of the developers of power worldwide, they are looking for this as a business perspective. And this is their right to look at it like this, because in the end, they are business people. But I think we have a lack of social responsibilities given to this side to cover this part of gap of power. Because, you know, everything's linked with power. There is all our life or our job, industrial business, everything's linked in the end with power availability. Now there is one problem, banks and DFIs, they are always blamed that the project, it's not bankable. I think we need to have a lead to teach a lot of countries, leaders, how they built the network or the structure to have a good bankability project, or at least to know how's the mechanism of building this kind of bankable project. Because without bankabilities, banks and other institutions, they will be not interesting. From other side, if you look to also other financial institutions about timing also, they are open about timing, sometimes take years. Why? Because they are looking more and more for project to be more in bankables. I think the best way to reduce or to increasing the appetite of risk, which is they should take it in this kind of project. Because in the end, if we're not taking the risk of this project or of this country which is have lower rate, we will not deliver anything. It will stay a long time without power. I also, if you look to Emirates, there was the leader in going to this high-risky country and to invest and to taking the risk and also to develop the mechanism of bankability of project in a lot of country which has a low-grade rating, and they do a lot of best project, good project in different kind of country, which is if you go to banks or if you go to private insurance company or any institutions, they will be not have appetite. Even if they have appetite, they will have a lot of inquiring for a lot of documents, and it's keep years and years. Now, even if you go to banks or financial institutions, they need a lot of documents, which is sometime the project validation is finished before they completing the bankability of documents. It's meaning they need again to go government to convince them again to come back again to project, and they stay years and years like this. So I hope for futures, banks and financial institutions, they built a different kind of structure. They're increasing their appetite. They're reducing their time to reach to real deliver to these projects.
Yes. I really like that. It's a very strong comment around the essentialness of creating simple structures, creating replicable structures, beware the bespoke in a world where we need to make sure that capital in its fastest form is capital in its simplest form. So I think that's a really strong point. We're very conscious of time because there's an incredible lineup of speakers in the Global South Utilities Forum today. So we're going to end on time for sure. I'll just invite the panel to any final remarks they would like to make in terms of the outlook for next year or something which you'd like the audience to leave with in terms of unlocking capital for the Global South? So any remarks? In no particular order, dive in.
Maybe I can start. So if the MDB can focus on platform rather than one-off deals, more on risk allocation rather than risk avoidance, I believe that we can unlock significantly more private capital within today's constraint. Thank you.
I think I'm personally quite optimistic about the different kind of solutions that we are able to bring in and put in place. I take your point as well on, how do we make things faster? I think probably as banks, maybe we should spend more time kind of doing workshops, being brought in on projects earlier on in the life of a project is really helpful as well. But I think that there's quite a lot of optimism as well from my side on the different types of structures that can be deployed, that can be scalable. I feel like sometimes we do take quite a lot of time because of the different requirements from our side, but it's definitely getting better from the perspective of, once you create a blueprint of something, being able to replicate it becomes much faster.
Yes. I think we need to restructuring the bankability of projects, or at least we increasing the appetite of risk for the power project, and we need to really do some real change to can be delivered easier and faster and quick.
I would just finally add to those great comments that from our perspective, it is about making sure that the countries are truly empowered to deliver on what they're seeking to deliver for their country priorities. And that's where I think all of us can collectively come and help with our different types of capital, our different technical expertise, make sure we're not overcrowding transactions, but trying to structure them in the most efficient way, enabling countries to deliver on their plans for the longer term.
So I think everyone in the room can now agree that capital needs to be unlocked for the Global South, and it's not about waiting for someone else to solve that problem. It's about everyone leaning in and solving it and being part of that partnership to unlock capital for 2026. Please join me in thanking the panel for their remarks this morning.